Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Regulatory Frameworks in Financial Risk. Regulatory frameworks in financial risk are essential components of the global financial system, designed to ensure stability, transparency, and integrity. These frameworks encompass a set of rules, guidelines, and standards that financial institutions must adhere to in order to mitigate various risks such as credit risk, market risk, operational risk, and liquidity risk. The governance of these frameworks is critical in maintaining the health of the financial system, protecting consumers, and fostering confidence among investors. The establishment of regulatory frameworks is often a response to financial crises that expose vulnerabilities in the financial system. For instance, the 2008 financial crisis underscored the need for robust regulatory oversight and led to significant reforms worldwide. One of the most notable reforms was the implementation of the Basel III framework by the Basel Committee on Banking Supervision. Basel III introduced more stringent capital requirements, leverage ratios, and liquidity standards for banks to enhance their resilience against financial shocks. Capital adequacy is a cornerstone of regulatory frameworks, ensuring that financial institutions maintain sufficient capital to absorb potential losses. Basel III's capital requirements mandate that banks hold a minimum Common Equity Tier 1 capital of 4.5% of risk-weighted assets, with additional buffers such as the capital conservation buffer and the counter-cyclical buffer. These buffers are designed to provide extra capital during periods of economic growth, which can be drawn down during downturns to maintain lending and absorb losses. The introduction of these capital buffers has significantly strengthened the banking sector's ability to withstand adverse economic conditions. In addition to capital adequacy, liquidity risk management is another critical aspect of regulatory frameworks. The liquidity coverage ratio, introduced under Basel III, requires banks to hold high-quality liquid assets sufficient to cover net cash outflows over a 30-day stress period. This measure ensures that banks have enough liquidity to survive short-term disruptions in funding markets. Furthermore, the net stable funding ratio aims to promote more stable funding profiles by requiring banks to maintain a minimum amount of stable funding relative to their assets and off-balance sheet activities over a one-year horizon. The governance of regulatory frameworks also extends to the oversight of systemic risk, which refers to the risk of collapse of the entire financial system. The Financial Stability Board plays a pivotal role in monitoring and addressing systemic risk by promoting international financial stability through the coordination of national financial authorities and international standard-setting bodies. The FSB's initiatives include the identification of global systemically important banks and the development of resolution frameworks to ensure that these institutions can be resolved in an orderly manner without causing systemic disruptions. Stress testing is another vital tool within regulatory frameworks used to assess the resilience of financial institutions under adverse conditions. Stress tests simulate various economic scenarios to evaluate the impact on banks' capital and liquidity positions. For instance, the Comprehensive Capital Analysis and Review conducted by the Federal Reserve in the United States assesses the capital adequacy of large bank holding companies by subjecting them to hypothetical adverse economic conditions. These tests help regulators identify vulnerabilities and ensure that banks have robust risk management practices in place. Regulatory frameworks also emphasize the importance of transparency and disclosure. Financial institutions are required to disclose their risk exposures, capital adequacy, and liquidity positions to the public and regulators. These disclosures enhance market discipline by providing stakeholders with the information needed to make informed decisions. The Pillar 3 disclosure requirements under Basel III, for example, mandate banks to publish detailed information on their risk management practices, capital structure, and risk exposures. The role of technology in regulatory frameworks cannot be overlooked. The advent of financial technology has introduced new challenges and opportunities for risk management and regulation. Regulatory technology solutions leverage advanced technologies such as artificial intelligence, machine learning, and blockchain to enhance regulatory compliance and risk management processes. For instance, AI and ML algorithms can analyze large datasets to identify patterns and anomalies that may indicate potential risks. Blockchain technology can provide transparent and tamper-proof records of transactions, enhancing the integrity of financial data. Regulatory frameworks must continuously evolve to address emerging risks and challenges. Climate risk, for example, has gained prominence as a significant risk factor for financial institutions. The increasing frequency and severity of climate-related events can lead to substantial financial losses and impact the stability of the financial system. Regulators are now incorporating climate risk assessments into their supervisory frameworks. The Network for Greening the Financial System, a group of central banks and supervisors, aims to enhance the role of the financial system in managing climate and environmental risks. In conclusion, regulatory frameworks in financial risk are essential for ensuring the stability and resilience of the global financial system. These frameworks encompass a wide range of measures, including capital adequacy requirements, liquidity standards, stress testing, and transparency obligations. The governance of these frameworks involves the coordination of national and international regulatory bodies to address systemic risk and promote financial stability. As the financial landscape continues to evolve, regulatory frameworks must adapt to emerging risks and leverage technological advancements to enhance risk management and compliance processes. By doing so, they can safeguard the integrity of the financial system, protect consumers, and foster confidence among investors. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UXL, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.